The lesson for today is how to nail profits in a correcting market or even a correcting sector, and certainly a correcting stock. And we're going to use volume and support and resistance. Really simple. You know, I've been trading for a long time, and these are my two favorite things to find technical conditions, to find opportunities, particularly for a credit spread. So let's go through an example. This is a chart that I took right out of Tom's Tools just last night. And this is the financial sector. Okay, so what you're seeing here is a breakdown on increasing volume. All right, so that's a sign. When this is distribution. What's distribution? Well, it's where institutions are distributing or selling stocks. You can see it by looking right here. So the volume is another way to think of volume is institutional conviction. So institutions, which control 80% of the market, are dumping stock, distributing stock. So those are slightly just above average, but certainly we've got 2 distribution days across the financial sector. So this is the XLF. Now there might be some banks there will be some banks that are dropping harder than others. And if you want to profit in this way, then we may even take a look at stocks in the financial sector that are dropping the most. And so the idea here is with volume, and stocks that are breaking down, derive support and resistance. Okay, so these levels here, you'll notice are every 50 cents on the XLF. So these purple lines are showing support there, support there, support there. Now resistance, support, resistance, resistance, support, resistance. Right here, this is a very key level at 35. And all of these are key levels. Here's another one at 34.50. I'm just connecting the, I'm really just drawing lines at every 50 cents. And coincidentally, in quotation marks enough, you'll see that there's bounces off of these levels. All right, so what I want to do here is derive where these levels are and then sell credit spreads at some level above. Now, there's some benefits to this strategy. And so in this particular case, we've got a breakdown below 4 support levels. 1, 2, 3, 4. We've got volume spikes, and we've got some very bad news. So all of these are pointing to, well, the stock may keep dropping, but what about recovering? The chances of it dropping are pretty high. The chances of it recovering, meaning that the stock breaks back up above these levels, is lessened. And when you couple all of this together, you get high probability of profits using credit spreads. Now, the icing on the cake is when stocks or sectors, ETFs in this case, drop hard, the options get more expensive. So this red line is the expense of the options. So we can sell credit spreads that are more expensive then. And that allows us to sell the credit spread maybe further away from the heat, the stock price, to increase our chances of not losing. Or like said it a more positive way, our chances of winning are amplified by the fact that options are really, really expensive right now, at least on this sector. So here's the idea. With all those conditions present, you want to find a support level. In this case, this is actually a resistance level. Let me change that slide there. Resistance is up top. So the idea here is going to be to sell a credit spread at one of these resistance levels. And the higher, the better. The higher you sell them, the more probability you have of winning. And in exchange for that, you take on a little bit less profit. Okay, so as you go from, imagine selling a credit spread that makes money below 33.50. All right, there's a chance that the XLF may rebound and pop right back up above that resistance level, and we could lose money. If I put it here, less chance of that happening. If I put it here, less chance of that happening. If I put it up here, that's where I'd like to sell, because for me to get into trouble, the stock is going to have to bust back up through 1, 2, 3, 4 levels before we get into trouble. So these resistance levels are layers of protection. And the further you move up, in this case, we're going bearish, the further you move up, less return on investment, but a higher probability of profit. One rule of thumb I like, but there's a rule of thumb is to receive at least 1 percentage point of ROI per day in the trade. So receive at least 1% per day in the trade. So if you sell a 14-day credit spread, then you want to have at least 14%. We'll review all of this here in just a minute. So that's the idea. So selling credit spreads on tanking stocks. This is something that I personally did back when COVID hit in 2019. And it's really kind of like shooting fish in a barrel. If the market sustains its breakdown, which there's every possibility that it will. So we're looking for these rules. And the scanner that I'm about to show you was built around this system. So back in 2019, this is how I was doing credit spreads. And then the developers over at Tom's Trading Room built a scan based on these rules. And you're already using it. You probably didn't know that all this was in here. So I'm looking for high volume breakdown below support levels. I'm looking for bad news. We have it. And then to sell bear call spreads at a resistance level and get at least 1% per day in the trade. Per day in the trade, the number of days in the trade is the number of days before expiration. So 1% per day in the trade. So one place you could start, although volume is everywhere right now, is you can actually find high volume stocks right within Tom's tools by going to a ranker. I'll show it to you in a minute. The ranker is called stock volume. And here you can go after the entire universe if you like, all optionable stocks and indices. You could also, if you like, go after penny plus weeklies, which are tighter slippage, more expiration stocks. You hit search and then confirm the volume with bad news, support, resistance, and then look for breaches of support, which becomes resistance. Also consider moving average and trend lines as those support resistance levels. So that's what I wanted to show you. I'm going to go right into the tools here and show you where this volume ranker is. I'm going to go to stocks, stock analysis, and stock volume. I spoke about this scanner a while ago. And I think about 2 months ago, I might have done this one. You can go after all optional stocks and indices. In this case, because there's so many of them, I'm going to change my list to penny plus weekly and then hit search. And that will give me a list of the highest volume stocks. And let's take a look at some of these here. Well, not surprisingly, the KRE, which is regional banks, Schwab is on here, DocuSign's on here. These three stocks here, the volume is immense. Look at the volume percent change here. It's immense, 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 immense. XLF is on the list as well. Bank of America, VIX, the VIX futures, the VIX ETFs and the futures are up. So I didn't look at the futures. Let's pause for a second and let's look at the VIX futures. That's a really important one. Oh, wow. Look what's happened to the VIX futures. We're up at 26. Okay, so the VIX is rising this morning as well. Now, Bank of America, I mentioned Deutsche Bank, US Bank Corp, JP Morgan. Let's look at some of these pictures here. There's your volume on JP Morgan. The bank sector is coming apart, everybody. Now, I could look through all of these, or I could say, all right, well, let me just save. The volume is immense, everybody. This is huge. Most of it is going to be down volume. Let's say I want to look for, let's take the top 100. So even if I go all the way to 85, the 85th stock on the list, that's a double average volume. I'm going to take the top 100 here. So these are the biggest volume stocks, save the top 100 and replace them in my stock list. Okay. Okay. Now that I have only the top 100, these are the highest volume stocks. Most of them are going to be droppers. And then I can go into searchers, single strategy, and call credit spread. So let's grab it and take a look. Call credit spread. And then I'm going to sort by, or set my wizard setting to default parameters, short term. I want my stock list now. And if I hit search here, this is going to, before I hit search, I want to show you one more thing. So this scanner is actually going to implement stock close percent change and only put credit spreads on stocks that have dropped the most over the last day. You could make this 2 days if you like. I'm not suggesting you do that, but you can play around with the number of days here if you like. But I'm going to do 1 day. In this case, hit search, and let's see what comes up on the radar. Now, this scanner is going to put them pretty close. All right, this scanner is going to put them slightly out of the money, which means in a call, slightly higher than the current stock price. And it's going to give you some pretty remarkable trades here. This one on Love, it's not a bank stock. We're going to look at some live. It's not going to be Friday's data with the markets coming down and banks coming down this morning pre-market. It's not going to be a lot of value for us to go through digging into some of these trades for today, but just for sake of example, let's do that. So when you run the scanner, it gives you the stock, various pictures, the stock and the IV. Southwest Airlines had a lot of volume here on this day. The IV's rushing. That's the kind of stuff we want. Here's Morgan Stanley. Let's take a look at this. Ooh, I'm not trying not to get excited. This I'm a little bit concerned about the economy, the U.S. economy at the moment. We don't need our banks to go be suffering like this. Anyway, here's the expense of the options increasing, and the stock has come down hard. Okay, so on Friday, what would have made potentially some sense is taking on this 7-day credit spread. This could have been done on Friday afternoon. This 7-day credit spread with a probability of profit of 79.64 to make a maximum of 38.89. So let's grab it. I want to go ahead and click the legs here and illustrate this whole probability thing. So if you look at the risk graph, you know, there's the break even right there, which is pretty much the high of Friday's day. That's like stepping up to the heat. That's like getting really close. The stock is at 90 and we're selling just 2.5 points higher. So it's kind of like, you know, I call it stepping up to the heat. And even with that proximity, you're still making 80%, which is extraordinarily high. And the reason it's extraordinarily high is because the IV is also extraordinarily high on Morgan Stanley. Now, if you want more probability, here's what I'll do. I'm going to go to a stock chart on that day. So I'm going to duplicate the tab, stocks, charts, stock charts. And then I'm going to look at a stock chart. Where's my support resistance levels? Well, look to see where there's turning points. Here's a level that catches my eye. And why? Well, and the level is 96. If you look at 96, support there, resistance, support, resistance, support, resistance. That would be about as close as I'd like to get. And if we were to sell there at 96, remember, that's our line in the sand. 96 is where we need the stock to stay below in order to collect some profit. So when I see that line there at 96, for me to get hurt on this trade, the stock, which is currently at 90, support would have to bounce back up above 1, 2, 3, 4 resistance levels before we get hurt on this trade. Let's grab 96 here. That's going to be my short strike. I'll duplicate this trade and we'll compare the two. All right. Now, how much am I going to get? I don't know. I just don't know exactly how much I'm going to get by selling up here versus right down here. It'll be less, but is it enough to make it worth it? So I'm going to edit my trade and I want to sell 96. Now, I don't know exactly if there's a 97 up here. I could just put it in and hope, or I could scroll down here to where you see March 17 and I can see what strikes are actually available. All right, so I want to sell the 96 and I want to buy the 97. All right, the tighter the credit spread, the more return on investment. And since we're going so far away, I'm mostly interested in squeezing as much of the risk out of the trade as possible for contracts yielding a higher return on investment. All right, so this is what you could have done on Friday as well. And you could have gotten 10 cents. Slippage is a little wide here, but just put that aside for the moment for concept. But you could have gotten 10 cents on one contract, making 11% over a 7-day period with probability of profit of 95.7%. That was available on Friday. 95.7% chance to make 11% over, in this case, it would have been 7 days. This trade would have expired, will expire on Friday. And of course, I got to take a look at Morgan Stanley to see what it actually did. I'm sure it's down today. Let's see. It is. So that credit spread today would be worth less. Okay, let me zoom in here. I want to demonstrate something else. There's an added benefit to selling credit spreads in this environment. I'm going to zoom in from 80 to 110 to zoom in to this part of the risk graph. Let's go from 80 to 110 and then hit risk graph. And let's zoom in. I'll tell you the icing on, there's even more icing on the cake. The icing on the cake is, well, stock goes sideways, we make money. Stock tanks, we make money. Stock stays below the break even at expiration. By this Friday, we'll break even. We'll make money below that point at expiration. So the problem, the thing we have to watch out for though, is if the stock were to recover, then we'll start losing money pretty fast. So what's going to, the icing on the cake is that because we're selling expensive options, what would happen if Morgan Stanley recovered and started getting up to where it starts to get painful in our credit spread is that IV would drop. IV would drop if the stock recovered. And what does that do to the risk graph? Well, I'll tell you pictorially, and then I'll tell you the Greek. So if the stock were to recover, these lines are working against us. So as IV comes out, what would happen is these color lines get sucked towards the profit line, the profit area. They get sucked to the right. IV comes out. It's like the trade breathes out IV, and like your ribs going back to your spine, IV comes out. These move towards expiration. So that's a little bit of a safety. It's not a big safety net, but it definitely helps. In the event there's a recovery, you'll lose less. That's what it means. In the event that the Morgan Stanley were to recover, you would lose less than if the IV wasn't elevated and dropping in the event of a recovery. So your Vega in this case is going to be negative. So that negative Vega says that if IV drops 1 percentage point, you'll make 69 cents. And that number will get even more negative as the stock approaches the 96 call. So the Vega will get higher. You'll make even more money. This Vega will help you as IV drops. The sign of the Vega indicates your position's bias towards IV movement. Negative means down. IV drops 1 percentage point, you make 70 bucks. And that's down here, but what will happen up here is your Vega will get even more negative. And that's just going to suck these lines with more veracity towards the right, losing less money. And of course, our theta is positive. We're making $1.92 a day. right here, and that number will get higher as well if the stock starts to rise. So we've got this thing. It's not a checkmate by any stretch, but in the event there's a recovery, we're going to not lose. We're going to mitigate our losses on this trade. And then if the stock drops, of course, we're going to pull this off. We would pull this off for maybe a penny as the stock falls down or just goes sideways or stays below this short strike by expiration. You want to pull it off right before, right when you can collect 90% of your max profit. Exit rules on these things are if the stock closes, in this case, a bearish trade, break evens above, the stock closes above 96.10, which is this number right here. That's the break even. You get a close above that break even, pull it off. Right now, that would lose you 40 bucks on this trade. But again, IV coming out, time decay coming out would suck these lines this way. Right now, if you were in this trade on Morgan Stanley, the stock's at, let's call it 88, right there. On this risk graph, we would be right about here. Now, we'd have 2 days of time decay on this thing. So what, $4 or so would have come out over the weekend. We would be, probably right about here with a nice little profit today had we placed this trade on Morgan Stanley. So that is the general system. And because the markets have come down since Friday, I'm going to have to do this live. I've got some stocks that I want to look at, but let's take a look at the overall markets here. Here's the S&P 500. Lower lows. Volume is already half average, and we're like 6 minutes in. Expect a super duper high volume day today. We're right at support at 38.50 or so. I don't know, man. Looks like we're dropping. We're going to drop more today. See what Biden has to say. Here's the SPYs. Wow. The SPYs have tanked quite a bit. Regional banks, KRE. Oh, mama. Wow. The regional banks we have the XLF, which is the overall financial market. And then regional banks are the ones that are most subject to liquidation because they're not as big as Bank of America or Wells Fargo or Chase. So the regional banks is really the sweet spot for opportunity. So the next question you might have is, well, let's find something for right now. So first off, I want to create a list of regional banking stocks. So I'm going to copy this into the chat box right now. And this is a link. And these are free. This is the first time I've been to bar chart for this. I just did a search. So I wanted to find a free way for you to get the component stocks for regional banking, KRE. KRE is a good stock all by itself, but you could also perhaps look for some of these other smaller banks dropping harder than the overall index itself, which is down 2.3%, actually 4.39% today on regional banks. Now you can anticipate the IVs off the roof as well. So these are the stocks, and this is all of them. And what I want to do, oh, it's not, there's even more. Show all. There's a boatload of them. Now what I'd like to do is copy all of these and put them in a stock list in our preferred tools, Tom's tools. So I'm going to go ahead and click and drag my trackpad or your mouse, if you don't have a trackpad, and just grab all of the text, highlight it, and then press Control-C on a PC, Command-C on a Mac. So now I've copied the stock symbols, the name of the company, as well as the percentage of holding and the number of shares, which aren't even being displayed. So I've copied that. And then what I'll do is go into website, lists, and edit list. And I'm going to create a list of all of the banking stocks, or the regional banking stocks, to be very precise, regional banking stocks. And so you've got 20 lists here you can play with. I've already set this up. Let's grab one of your lists or blank lists or lists you don't want anymore. Give it a name. regional banks. And I put KRE in there because that's the ETF. The ETF symbol is also in there. And then I'm going to Control V or Command V on a Mac. Control V or Command V on a Mac. Paste everything in. So it's got all the symbols as well as a bunch of other stuff that's not symbols. And then when you hit save, the scanner will parse out, excuse me, will parse out everything but symbols. Now it is possible to have like an A in here or an AT. So words that might also be used in text are possible in here, but in this case, I don't believe that's going to happen. Yeah, there's an A there. So what is that, Agilent? I think that's Agilent. All right. So there might be some that aren't banks, and just when you get to it, you'll know. So nothing to worry about. So that's my list now. I've hit save, and now I'm going to go out and take a look. Go to searchers, single strategy, and call credits. And now I'm going to go after what I did that I just demoed is default parameters short term. Let's grab my regional banking stock list, KRE, and then hit search. Once again, this data is not today's data until 20 minutes from now at 10 Eastern. So let's go ahead. Okay, now none came up on Friday on the list. Now, some that I looked at, we could also do the entire financial sector, the XLF. We'll do the same way. And we'll have overall financial industry as well as banks. The overall financial industry, which includes banks, and then the XLF, which includes the big financial institutions, including banks, bigger banks. I'm going to copy all of them just like I did, and I'm going to create a separate list for overall banks. So lists, edit list. I'm going to look at my stock list here. I don't have the XLF. I'm going to have, there it is. There's the XLF. And I'll overwrite this list by pasting and then save the XLF. And now I can go to searchers, single strategy, call credit spread. Anybody know, anybody have an idea why the scanner is kicking out some of these trades? Any ideas? I know why. Why do you think? When markets collapse, market makers are going to be concerned about, losing money. So what do? They widen the slippage. The slippage is wide on the regional banks because that's the sector that's in the most hot water at the moment. And there were none that came up there, but certainly here you can see that quite a few have. Let's take a look at some of these stocks. Citigroup. I'll look at them live here. Yeah, my God. Citigroup's coming down hard. What's the next one? Bank of America. Yep. BAC. Wow. Wow. I gotta admit, I like bearish markets, but I don't like people to lose money in their accounts. So I'm kind of mixed about it. I don't want to see our banking system, suffer like this. It's important for all of us and as well as markets. But the other side of me is like, man, this is a really fast way to make some money in a high probability fashion. So there's a lot of them we could look at. Morgan Stanley is another that came up on the list. Wow. A couple I was looking at before we started today. Schwab, you got really hammered last Friday. Where is it today? Oh my goodness. Oh my goodness gracious. Look at Schwab. We may want to do something with Schwab. If I could sell up here at 60 on Schwab, then I might do it. I would do it if there's anything there. And the issue we're going to deal with is going to be slippage. So I'm going to go into a live option chain for Schwab. And let's take a look at slippage. Look at our slippage, everybody. For an 11-day option, sell in the 60s. Let's look at the 60s. That's where I want to sell. 25 cents by 750. So this is the issue that we have, is the market makers, because it's Chicken Little sky is falling, are widening the slippage to gargantuan levels, 25 by 750. Now it's the first, 14 minutes of the trading day. So this will normalize because, I know it's normalized. It will normalize, at least maybe not on Schwab, but on the others, is because the slippage was good enough to make the scanner last Friday. So these big banks here, here's Schwab, the slippage on Friday for Schwab. Here's your slippage column. Friday's slippage on Schwab. Wow, it was 100% on Friday as well. So slippage, and if we look down the slippage column, you can see that it's quite high. And that slippage, that was end of day on Friday. Now, end of day, beginning of the market, slippage widens and then it tends to contract. So that's something to know, because if you're in and you get out during the day, maybe lunchtime, midday, 1 o'clock, 2 o'clock Eastern, your slippage will be more normal. But then by the end of the day, I was looking at the wrong column. Sorry about that. Whoop, 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 whoop. Backing up. I was looking at the wrong column. I'm excited. So the slippage is actually pretty tight at the end of the day. Even on Schwab, 5.67% on Friday. Currently, though, the slippage is nuts. The slippage is gargantuan. It's getting better. See, it's getting better. 215 by 345. So we want to wait for this to get a little more normal before we hop in. So there's Schwab. Let's take a look at the KRE. If anybody has one in particular, goodness gracious. This is nuts, everybody. Look, just a week ago, it's at 60, and now it's at 43. It's gapped down hard today. So if we took a look at its options trade, these are the March 24s, a week from Friday, and the slippage is just nuts. The market makers aren't even letting you sell these up here. You can for zero, or they'll give you something for it, but they're really making it hard to get out of these out of the money options here. At the money though, even that's where we kind of should look. The slippage is about 25% wide currently on the KRE. So we've got to be careful on all of these. FRC is the other that was in the news just today. First Republic. There it is. Oh, look, it bounced. No, it didn't. It's down here. Look at that. I bet you slippage is mega wide on this. People are concerned that First Republic Bank of San Francisco may go under. Let's take a look at our slippage here. We only have 21-day option, 21st of April or 17th of March. Slippage is super duper wide. So unfortunately, that's what the market makers have to do to protect themselves, is to keep the slippage pretty wide. So Chicken Little sky is falling is what's happening with banks. So what I would say to you to do is to replicate the steps I've just given you later in the day, and look for credits on some of these stocks. Now we could go to some of the more liquid companies like Citigroup. Let's take a look at Citi. Let's go to charts. Yeah, Citigroup's coming down hard. If we could sell at 50, it's at 48 to 50 up here on Citi. That could be a good move. Let's look at the XLF. I mean, God, there's so much. XLF way down here, 34. I would sell at 34 here, which is right at the 200, and 35 would be preferred. Let's take a look here. And the IV is going to be high. Oh, wait a minute. Slippage is quite tight on Citi. All right. I